Every founder has to unlearn the hustle. Otherwise, it becomes a trap. In the early days, you were in survival mode. Hustle, speed, and control were your superpowers. But as your company grows, these same instincts can backfire. As you're scaling from 7 to 9 figures, be very clear about what your constraints to scaling are. Dylan, we're back. Episode 18. What's happening, man?
Not much. I'm excited to chat about scaling from 7 to 9 figures. I feel like this is a fun one. I'm looking forward to it.
Skipping right past 8, we're going straight to 9, baby. No, just kidding. This is a great one because I think that from my vantage point, I think that there's a lot of, my friend Ryan Rouse, he's like 8 years older than me. I really look up to he's been in like ecom and consumer for that much longer than me. And he's a content creator. It's funny because he's my friend, but I follow his content like religiously because he just has a lot of really wise things to say. And there's something he says about this that like, if you've never made it to 9 figures before, you don't know what to expect because you've never been there before. Right. Yeah. And it's not that you're incapable of getting there or staying there. It's just that you literally don't know the difference between 9 figures and 8 figures. And so like I've seen several brands get to 9 figures, have been lucky enough to be a part of it. And so I'm excited to share a little bit about like what I've seen work to go from 7 to 8 to 9 and hear what you've got to say as well. So to get kicked off here on your side, what are some of what would you say is like maybe the top most common mistake that you see when there's a brand that's trying to scale to 9 figures?
I think this is like a true statement, whether you're at 7 figures, 8 figures, 9 figures. And it's one of the great benefits of working in agency space is we get to work and collaborate with so many operators and see like what strategies work, what approaches work well. And I say like the one rule that I've observed is that whether you're at 7 figures, 8 figures, 9 figures, is thinking very deeply about, is what I'm working on today the highest leverage opportunity in the business? So I'll give you an example. Like when you're first starting out and you're maybe even at 6 figures, the biggest opportunity is probably once you have your product, developing ads and making and launching campaigns that can meaningfully move those products at a good efficiency. Over time, let's say you've launched 1,000 different ad creatives. Chances are is you've probably established roughly the highest possible ROAS you can get with that product and offer. Once you get into the next phase of growth, the next best high leverage thing might have something to do with your unit economics and your supply chain. It might have something to do with developing new offers. It might have something to do with developing proper financial controls as you grow. And for every business, there's different sizes and kind of points where those like most high leverage things lie. And I think that like any business owner, no matter what size you are, can sometimes get focused for too long, focusing on the thing that got you to where you are. And maybe it's still important that that's done well, but maybe it's not the place where you can allocate your time to go and get that next run of revenue or profit or whatever. And I think that that's one of the things that everyone kind of has to always internally think about is what I'm doing right now, the best way to spend my time within my business. And at a high level, that's the most common thing I see is like people getting too stuck on the thing that worked previously.
Yeah, I want to build on this a little bit because when we're talking specifically about going from sub 10 million a year in revenue to 100 million plus, right? What I see as the greatest challenge is very akin to what you're saying or some of those examples you gave, Dylan, but that you have to go from you affecting the change to building an organization of other people that affect the change. Yeah. And it's funny because I know I mentioned my buddy Ryan Rouse, his LinkedIn post today. I'm going to read this to you because like this is hit home. Every founder has to unlearn the hustle. Otherwise, it becomes a trap. In the early days, you were in survival mode. Hustle, speed, and control were your superpowers. But as your company grows, these same instincts can backfire. Your bias for speed becomes micromanagement. Your need for control blocks your team from stepping up. Your problem-solving reflex keeps others from owning outcomes. In short, what got you here won't get you there. To build a company that scales, you don't just need to learn more, you need to unlearn more. And it's this almost kind of like contradictory, it's like this paradox. At the beginning, you had to hustle and do everything. As you start scaling to a sizable brand, you have to learn how to build systems and allocate resources to get high leverage activities done. And so what you do as the founder that's quote high leverage has to change. It has to change from you doing a lot of work with your own hands to letting systems and people and other resources get those things done. And I got to be honest, I've done it several times personally. It's the hardest part about business, and it's the hardest part about scaling, in my opinion, because you have to let go of control in many different areas, but trust that your systems and your people and your guiding principles are going to produce the outcomes that you're looking for. I would say the other biggest thing that I see is not properly, I guess I'll call it not properly sequencing sales channel expansion on the way to 9 figures. And I think this starts, well, I know we talk about this all the time on the show, but it's like, this is so important. It starts with an assessment of how strong your LTV is, right? Versus like how, and then it goes to an assessment of the TAM in the existing channels you're in. So let's talk about it specifically through the context of a brand that started D2C, right? Exclusively D2C. I have a brand that we work with that's on its way to 9 figures that is still mostly D2C, but 1, there's a huge TAM, and 2, they have crazy LTV. The 3-month LTV is amazing. The 6-month is amazing. The 9-month is amazing. The 12-month is amazing. Why is that important? Because if you think about TAM and LTV are really important to analyze together when you're talking about how big can you grow your D2C channel. Because if you're a new customer dominant brand, the TAM you're talking about is the TAM of net new customers you can acquire at a profitable CAC. Whereas if you're a strong LTV brand, the TAM you're talking about is can be effectively a smaller number of people who are just purchasing from you more frequently. In fact, I think it was Jacob from Aplo, one of your business partners. He had this really cool post not that long ago, a week or two ago, that said that your LTV over, I can't remember what time periods, I'm just going to guess, your 6-month LTV or your 12-month LTV is your brand's organic growth rate. And the concept that he was pulling out, I think is really helpful to think about, which is that like if you think about your organic growth capabilities within your brand, if you're not going to do any paid to get new eyeballs on your brand, it's how much do you expect to be repurchased from your brand over some time period. And so the point being, the TAM to get to 100 million, when you talk about sales channel expansion, a brand can probably stay, generally speaking, on the D2C channel longer, exclusively on D2C longer, on their way to 100 million, the stronger their LTV is. The weaker their LTV is, you may need to consider sales channel expansion sooner to get to 100 million. But you need to talk about these things internally and think deeply about them early, not when it's too late and you're already hitting the ceiling of D2C. Do you have any thoughts on that, Dylan?
Basically, the benefit to LTV is that you can probably stomach the increased ad costs better than someone who does not have the LTV. So generally speaking, I'd say that's directionally right. It's not to say that if you're a first-time customer dominant brand, you cannot have a $100 million DTC standalone business, but traditionally those total addressable markets are going to be very large. So definitely agreed there. I guess from your perspective, Jon, are there any most common mistakes you see in different revenue tiers? We'll call it 1 to 10 mil, 10 to 50, 50 to 100, that you think happen the most in those different ranges, or is it kind of a mixed bag?
Okay, so it's a good question. Off the top of my head, 1 to 10 million, I think probably the most common, it's a tie probably between two things. One is just really poor inventory planning, getting too, getting too overstocked on inventory positions, which is like very unsophisticated inventory planning is a very common mistake. But I think the other one is actually diluting focus too soon on either new product launches or new sales channel expansion. And again, this is the tier below 10 million. It's like we've gotten into way too many sales channels and we're launching way too many products. And it's like the diluted focus is actually making it hard to break through 10 million. And I'd say like, what was the second one? Did you say 10 to 20 million?
10 to 50. I gave you pretty big. Feel free
10,
to change
10 to 50. 10 to 50, I think the most common mistake I see is the sales channel sequencing. And really it's that analysis I just said of like, with our LTV, like with our current LTV makeup and the TAM that we have available to us, like, should I be expanding into another sales channel? And I see oftentimes high LTV brands. I know product category can depend, but generally speaking, high LTV brands have a much better chance to get to 50 million without real significant sales channel expansion. I've definitely seen some brands get to 50 million that are new customer dominant, but are somewhere around depending on the product category, somewhere around 35 to 50 is where, like, if they don't start expanding into either physical retail and or Amazon, I really start seeing new customer ROAS like really breaking down, and all of that profit that needs to be generated on new customers like starts going out the window, and it starts getting really challenging. And then I would say beyond 50 million, the biggest challenge I see is like, or biggest mistake I see brands make is like founders not really having a leadership team in place. And really, at the very least, core functional leaders, like truly an executive leader of marketing, an executive leader of operations, and an executive leader of finance. By the way, those don't have to all be full-time people. In fact, I think in a lot of brands, several, if not all of them, can be. I usually see the ops leader needing to be full-time first, and it's usually because there's so much nuance. There's like a full-time job to manage the supply chain and inventory planning and fulfillment. Usually you can get away with fractional CFO depending on how complex your business is. Oftentimes I see ecom brands, even multi-channel, be able to get away with a fractional CFO until they hit 100 million. And oftentimes on marketing, you don't need a full-time marketing leader. But I think you need to hire a VP of ops or a COO or whatever you want to call it by the time you hit 50 million, if you don't already have one. Or that stuff can, as soon as ops breaks down, marketing can't do their job. Doesn't matter how well finance does their job. Like, you need to be able to keep up with the scale, the increased scale that happens operationally between 50 and 100 million. Do you agree with those, or do you have any thoughts?
Yeah, I would say definitely agree with all the above. The only thing I would add is, like, to this day, I'm still frequently surprised at how many brands in like the 10 to 50 category do not have like their financials in order, and they think one thing is accurate and like another thing is not. And as the marketing side of this, like when we go about trying to set KPIs, targets, and planning, it's all based off of historical data and the accuracy of that data. And I think that like the most common advice I give nowadays is like, make sure you have that side of the house like well maintained, because oftentimes things can break down, especially as you get to bigger numbers. Oftentimes, in some ways, the risk gets a little bit bigger. You may have to use more debt, more this, more that, and the stakes just increase more and more. So having that definitely unlock is a key thing that's important.
Dude, I totally missed my opportunity to shamelessly plug that I run a fractional CFO firm, right, in the e-commerce space. No, I mean, but so on let's talk about just the accounting and finance side, right? Yeah. Biggest mistakes I see in those same kind of revenue categories from 0 to 10 million, it's cash basis accounting instead of accrual, which is a huge mistake because there's no visibility into cash conversion cycle and the health of your balance sheet very clearly biggest issue I see. From 10 to 50, the biggest mistake I see is not hiring a fractional CFO or someone in finance as opposed to accounting, right? That can help you actually forecast and plan. And beyond 50 million, on the accounting and finance side, I'd say it's not using your scale, right? And hopefully profitability, like not just scale of revenue, but scale of profit, to really start thinking about strategic finance in the areas of optimizing your capital structure. So that means like the use of debt versus equity, because beyond 50 million, you start having access, you open up access to like much cheaper bank financing as opposed to non-bank financing, which can really open up unlocks for not just investing in growth, but distributing cash to yourself as the owner. And I think like if you own a brand that's profitable past 50 million on your way to 100, you should absolutely have a CFO who is helping you extract cash out of the business and helping you fund the ability to build wealth outside of an exit by taking regular cash distributions so that you can go invest in other things, be it real estate, stock market, whatever. And so that's kind of the progression that I see on the accounting and finance side of like mistakes made.
I find myself more and more, that's like the most frequent recommendation I make. And I cannot stress it enough, not just because you run a fractional CFO shop, like it's just everything else breaks down if you do not have that in place.
There's a couple other things that I think I see at various revenue levels. Like it's not necessarily specific to a given, revenue band, but I think probably most commonly stuff we haven't talked about, I'm calling it getting new product trigger happy, overhiring, and then not being thoughtful about when you should hire a doer next versus a leader next. These are three that I see a lot. Like on the getting new product trigger happy side of things, it's like you got to some revenue level successfully, right? You're profitable. And usually what I see, okay, this is actually, I've got a question for you and I really want to know your take because this has come up a couple of times recently. So you get to some revenue level and profitability level with your existing product mix. It's been successful and you're starting to notice a business model or a market driven kind of gap in your business. And usually I see this happen in like seasonality. I've actually had 3 founders in the last 2 weeks who've been like, hey, listen, seasonally, we sell our products have strong demand in these 2 times of year. So I actually now want to launch new products that counteract that seasonality, right? Like let's say you're a summer product business. And I was just talking to a brand, they sell most of their stuff during summer and they're like, we're going to launch products that do well seasonally in the winter. And it's funny because I spoke at an event, the Final Loop event with Taylor Holiday, like several weeks back. And he said, and one of the things he said in his talk that I thought was really, really interesting, and I think I agree with, and I'm going to get your take. He said, do not try to launch a new product line that counteracts the seasonality of your existing business. I've never seen it work. It may work a little bit, right? But I've never seen it just like smooth out demand all throughout the year. He's like, instead, get good at understanding the customer that buys your seasonal product and create and take advantage of the moments. If you want to go start something that's counter-cyclical, start another business. Don't try to smash those brands together. Now, I didn't have a strong, fully formed opinion around this before, but when he said that, I started thinking about like the number of times I've seen this work, and I've never seen it work. Doesn't mean it's not possible. But what are your thoughts? Like, what's your take on like, if you have a highly seasonal summer business and you want to launch products that do well in the winter, have you seen that work? Is there some best practices that might make it work? I'm curious.
Yeah, so I would say that like that statement would probably hold true most of the time. Like probabilistically, if you're trying to get the best return on invested capital onto new inventory, like lean into what already works for you. So generally, yes, I agree. Like a counter to that, the simplest one would be like clothing and apparel. Like if you have like tees that sell well and you launch hoodies to help with like winter and cold month seasonality, like that's not such a leap of faith that it'll probably have a pretty solid return. I think like where it gets really risky is at the extremes where it's like, I don't know, I sell like bathing suits in the summer and snow pants in winter. Like there's actually probably plenty of clothing and apparel brands that do that. But like if you go to like just bathing suits in the summer, like, and then you're a summer brand, like the jump is much riskier because there's less likely to be a return customer because the similarities in those customers are likely to be different. So you're borderline launching a new business via a new product line that has very little overlap. So I think there's definitely cases where you can make the case for it. It's just like you have to have a baseline expectation that it's a low probability bet. Like it's probably not going to work for me. And if I want it to work for me, it probably has to work on ads. So that you just have to have that expectation going into it. But I would largely say that like if you already have a pre-existing seasonal trend in your business, instead of focusing on the down months, you should probably just focus on making the big months even bigger. Now the caveat to that is like you can do things that are like less investment heavy or resource heavy or time heavy to try and make those slower months better. Email SMS strategies. Maybe you do some other things, but if you're with new product drops, like low MOQ counts. But for the most part, if you're thinking about how do I as an owner of the company use my time or my team's time to get the most leverage on it, is it by getting a 20% improvement on the month that does like 3 million in sales, or a 20% improvement on the month that does $1 million in sales during the seasonal low time? And it's like, well, if I can move that big month even higher, that's going to be a better return on time. So I think that like there's always edge cases, but largely I'd say, I'm on board. One thing I actually might disagree a little bit with you on though is new product trigger happy. So I think there are some cases where getting new product trigger happy makes a lot of sense, specifically for like low LTV brands. And totally, I don't love it, but like it's a reality that some businesses have to face based off of the unique setup of their business. But when you think about, I don't know, let's say I'm doing 10, 20 million bucks a year in sales, first time customer dominant, low LTV, and my margins shrinking as I scale up spend, I've got a couple options. I either start thinking about other sales channels, other ad channels, or other products. And ad channels, even if you make them work, probably gonna like have only a small amount of incremental upside on top of that. So I'm almost gonna put that away for a second. Then you basically have either new products or new channels, and you just basically have to assess what game do you want to play at that point. Do you want to try and go after finding other winning products that can work on top of funnel, or do you want to go and play the sales channel game? And I think that's like a decision that has to get made based off of fundamentally what you're selling, what you and your team's skill set is in terms of what you think you have the highest probability of winning at, and then go and play the game.
We've talked about new product launch strategy, right? And we've also talked about like that scaling is a game of removing constraints. And I think regardless of whether you're talking about sales channel TAM as a constraint, or you're talking about, new heavily new customer dominant brand needing to, launch new products to remove a constraint. The bottom line is like the difference between getting like truly what I'll call new product trigger happy is like in my mind, it's like, hey, we crushed it before, so every product we launch is gonna crush it again. Yeah. Whereas like what you were just saying, there's a clear rationale strategically. Doesn't mean you're gonna be right. You have a clear line of strategic thinking logic that you follow to say, I'm going to launch this new product because I know I'm going to be constrained at some point because we're new customer dominant, right? But I totally agree. You need to make a choice of the game that you're playing on, either sales channel or new product, and they don't have to be mutually exclusive, right? You can do a little bit of both, but it's just about being thoughtful instead of like spray and pray. You know what I mean? The one thing that you mentioned that I wanted to double click into, because I think this is a mistake I see a lot of brands make as they scale, particularly from 8 to 9 figures, is not being honest about what they're really good at in terms of internal core competency. And I think either being really good at thinking deeply about that or avoiding it can be reasons that underlying reasons why I see brands make bad hiring or overhiring decisions as they continue to scale is they staff the wrong things internally versus resourcing it up with either outsource agencies or freelancers or part-time resources. And I'm of the opinion, and obviously this is like a whole episode in and of itself. I'm a big fan of this like general kind of like management concept of like, don't try to improve your weaknesses, like delegate your weaknesses to other people that are strong in those areas, right? Like you should double down on what you're strong at. And I believe that, like for me personally, as well as for organizations. And so you should be staffing internally your core competencies as a general statement, and you should be outsourcing your weaknesses to whatever agencies, freelancers, specialists who are very, very strong in those areas. And I actually believe that very, very strongly. And I think that brands should really think about how that conceptually applies to them as they're scaling. I think you've talked about that as well when we were talking about hiring in a previous episode, but like, do you see the same issue with just like staffing internally a weakness that really should be like kind of outsourced or delegated to a specialist as a brand is scaling?
Yeah, so it's very difficult because every like position is a little bit different. I would say that there are certain key things that are the highest leverage in an org. So like, for example, I would just start by looking at your P&L. What are the biggest line item costs? It's probably going to be your ad spend, your COGS, and your logistics fees. OpEx too, but we'll just pretend that doesn't exist for a second. On those specific areas, I would say it's relatively easy in many cases to justify having, like, even if you have in-house employees, having outside kind of consulting help in some way, shape, or form, people who have access to a larger data set because they work with multiple brands. Maybe they're affiliated with some sort of organization with a bunch of data. I don't know. And basically in those situations, you can often get like disproportionate returns just by having like another opinion in the room.
Totally.
And it's easy to justify those expenses and easy to prove them measurably because they are like line item expenses. So I would say that like I see a lot of cases where people will like in-house and like go from agency to in-house, and like maybe disaster unfolds, or maybe the flip side, maybe they go from an in-house team member, they no longer think that team member is like capable of getting them where they want to go. They go agency, maybe the agency loses context. Like I think it's better to have multiple people in your org who are capable of moving and managing that piece or that line item of your P&L. Like another example would be like, I do not think you should have a CMO of a D2C brand who cannot, to some degree of proficiency, run the ads themselves. I think totally. If you're like an ads dominant brand and your CMO does not have that know-how, I think that like that's probably a problem. But ideally you have CMO who can run the ads. Maybe you have a media buyer, and maybe you have like an agency or third-party partner. The flip side of that coin is that you can argue that that is wasteful, but for like really big brands playing a really big game, trying to go and do $100 million a year, $200 million a year, whatever, I think oftentimes because the leverage is so high and with that size of a business, often that is the best path to go down. On the flip side, though, because we were talking about overhiring, especially if you're a smaller brand or playing a smaller game or whatever, I still think a lot of brands have their fixed costs as a percentage of revenue just simply too high. I think a lot of people from like the last couple of years of D2C haven't, like maybe they right-sized. I think there's some situations where you could right-size even more. It is crazy how much operational leverage is being created with some of these AI tools. And I guess like my one rule of thumb is like before you hire anyone else, think very hard about the pre-existing team you have, how much additional leverage they can possibly get due to some of these tools. And think about like, hey, like if I can take this responsibility that person has and cut the time input in half because I can have Claude or ChatGPT or whatever automate a lot of it and make it easier to output that end outcome. Instead of taking on additional fixed costs, can I basically just use that time and retrain or train or have someone else kind of jump in on these tasks? I think that like overhiring is like one of the worst things you could do as a D2C brand. Like the whole point of a D2C brand, in my opinion, one of the main operational leverages you have over, say, another sales channel is I think your fixed costs, assuming you're not vertically integrated, at maximum should be 10% of your sales. Now, sometimes you can push because you're trying to go for a step function, but like I earlier this year, I think we had a podcast about it where I said 11, 12, 13%, like you're probably fine. I've changed my mind. Hard number is 10. I think that you have to be below that. That's the magic number to me, at least for so many brands.
Yeah, well, I would say on average, 10 is definitely the magic number. The one caveat, or the one from like all the P&Ls I see on a weekly basis doing our CFO audits, the one exception that I'll make is like there are some brands that are crushing it so hard on like LTV, and they're not scaling. They're scaling, but their LTV margin dollars are outpacing like their diminishing efficiency or profitability on new customers.
Yeah.
That like in that moment at 12 or 13%, their blended marketing efficiency is just like so strong that like they can have 12, 13% like or low teens overhead and they're good. To be quite honest with you, most of those brands have that because they have some very strong organic like content driven lead gen that's happening. A lot of their focus is in content creation, organic content creation, organic social. And so they actually do have more people in-house who are like they're paying to really stay focused on that. And it's a few very core mission driven like high LTV brands that we work with where I'm seeing that work. It's totally the exception and not the rule.
There are definitely cases where the low teens still like math out where it all makes sense. I just think that like as a general rule of thumb, as like the bar, I think everyone should be striving for that. And it's probably one of the easiest costs to control out of all the costs that you have at your disposal. So I do agree. It's we love the word LTV, John. Anytime we say LTV, it's like a little sparkle, It's like,
well, it's just like I think if I could sum up like the reason why we bring up LTV so often on this podcast is because like I think generally brands know LTV, more LTV equals good, right? When compared to lower LTV. And I think there are some obvious reasons why LTV is good. And I think most of the time it's talked about in context of funding new customer acquisition, right? CAC to LTV paying back, little to no profitability on new customers. That's the context within which it is talked about so frequently. We have uncovered or just like explained in the last 18 episodes that it actually applies to a lot else. It applies to inventory planning. It applies to debt financing. It applies to how much money you can take out of your business. It applies to many, many different things. New product development. It has a multi-dimensional impact on your growth, your capabilities to grow, your P&L, and your balance sheet, right? And there's just, I can't think of another thing that touches all of those things in such a deep way that like it doesn't mean you can't. We work with a number of brands that are probably going to hit 100 million or new customer dominant, right? But they're playing a different game. And I know we always talk about like, what game are you playing? If there's one thing you could take away from the Ecom Scaling Show, it's like take all the stuff we talked about and use it to decide which game you're playing and go play that game better than anybody else instead of just trying things, right? Or what I call random acts of strategy. So anyways, I feel like we've probably come to a stopping point here by tying it all back together with LTV. What are your final thoughts, Dylan?
Yeah, my thought of the week has actually just been like leverage. Like, where can you go and get the best leverage in your business? I think we also recently chatted about, like if you're trying to get a big change in efficiency or effectiveness of anything you're doing in your business, in terms of results, you need the actual change to be similarly large. And I think that when you're scaling from 7 to 9 figures, there's so many kind of key points and key things that have to be done right at different tiers of the business and new lessons you have to understand. And as the marketing guy, the thing I see the most is the financial literacy part and having that like effectively be managed, because we can't do our job to the best of our ability if that side of the house is not well kept. So whether you have an in-house media buyer, or in-house CMO, an agency you work with, that is just integral, in my opinion, to empowering that team to do the job the best they can.
I love it. I love it. My final thoughts, it's actually very closely aligned. It's as you're scaling from 7 to 9 figures, be very clear about what your constraints to scaling are. Whether that's your LTV makeup, it's the TAM, it's your product line. What are the constraints, right? Scaling is a game of removing constraints, and make sure you're always resourcing the removal of bottlenecks, the removal of constraints. That's one way, not the only way, but that's one way to make sure you're allocating resources to high leverage activities as you're scaling. So, yeah, man, this is a good one. Episode 18 in the books. Let's go.